Well, good evening, everyone, and welcome to tonight's presentation of Wealth Management 101, where we'll be showing you some of the wealth management strategies that may help build your long-term wealth in today's uncertain markets. Before we get started, I'd like to go over a few housekeeping points. First and foremost, I believe everybody is on mute. If you could, though, make sure that you have turned off or turned down your cell phones, any dogs in the back, just to keep the noise in the background to a bare minimum. Thank you. Also, if you have any questions about what we're discussing today, please feel free to raise your hand and ask. Chances are someone else in the presentation this evening is wondering the same thing. That being said, unless you're a client of ours, we know very little about your situation. So it would be impossible for us to say whether a specific investment is right for you and your specific goals. But if you have general questions, feel free to ask them, and we'll be happy to answer them to the best of our ability. Here are a few disclosures I'd like to bring to your attention so you may understand that there are risks to investing and nothing is guaranteed. It should be noted that there are no perfect investments. With every investment, there are benefits and drawbacks. There are also fees involved. So, as I discuss a certain investment today, I am by no means implying that there is a particular investment that is right for everyone. At other seminars, you may hear a pitch for a specific product or investment, but you won't hear that today. We believe there are no perfect investments. This workshop is for informational purposes only. The factors we will be discussing are just some of the things we consider when helping our clients. A little bit about us. We are a wealth management firm based in Tyson's Corner, Northern Virginia. And this is a quote we've had on our website for a while. This is a quote, obviously, from Ben Graham. For those who are not familiar, Ben Graham is the father of value investing, one of the first guys to look at the books of a company and decide whether it was a good investment or not. But he says that the best way to measure your investing success is not by whether you're beating the market, but whether you've put in place a financial plan and a behavioral discipline that are likely to get you to where you want to go. That really sums up what we try to do for our clients. We try to build out a financial plan and induce a certain behavioral discipline so that they can reach their long-term goals. Last little tidbit on Mr. Graham. Yes, he is from the prior century, but he basically was Warren Buffett before Warren Buffett was Warren Buffett. How about that? So let's take a look at our agenda for this evening. There are many factors that we need to consider along the way, such as market summary. We'll talk about our strategies to help protect your lifestyle from rising costs, common investment pitfalls, and some key principles. This presentation is designed to give you a good idea of some of the factors to consider when you want to build your wealth management process. Let's get started by taking a look at the S&P 500 index. At first glance, some investors would say that the S&P appears to have gradually climbed over time, and we would agree with that assessment. However, it may be easy to miss the periods of market volatility characterized by declining stock prices. For example, consider the volatility that resulted from the onset of COVID-22 pandemic. Though the recovery was swift and the market found new highs later that same year, investors won't soon forget the sudden and sharp decline in stock prices during that period. The stock market isn't the only thing we're going to talk about today. The health of the overall economy as a whole also needs to be considered. Let's take a look at the gross domestic product, or GDP. This chart shows the trend in GDP from January of 2021 to the first quarter of 2023. You can see the GDP growth has varied widely from quarter to quarter over the past couple of years. So, what will GDP show for the rest of 2023? Well, that's uncertain, but we can tell you that the Bureau of Economic Analysis, the BEA, releases two estimates, one final figure for each quarter's GDP. The BEA considers many economic reports when calculating the GDP, and those reports simply change over time. The Bureau's advanced estimate is based on source data, which is subject to further revision. The second estimate is based on more complete data, and the final figure becomes the official GDP for that quarter. So in Q1 of 2023, the second estimate was 1.3%, which was revised later to a final estimate of 2%. Sometimes there's very little change from estimate to estimate, but sometimes these revisions can be more dramatic. So that's a brief look at where we are with the stock market and the economy. Let's move forward to discuss some of the key challenges we face when building a wealth management strategy. Let's talk about inflation first. Let's take a look at how inflation has impacted the prices of critical items over the past 30 years. Now, inflation is the rate at which average price level of a product or service in the economy increases over a period of time. So you can see that in 1991, the average single home was about $97,000. A loaf of bread was 72 cents. A college education was about $5,400. Fast forward to 2023, the average single family home is a little bit over $500,000. Average loaf of bread is $1.95, and a college education is about $28,000. Many hope to experience an improved quality of life in retirement. The proposed agenda for many retirees is traveling, indulging in hobbies, and enjoying time with family. However, some may forget to factor in rising prices, and that's easy to do. The U.S. Bureau of Labor Statistics reports in May of 2023 that inflation was 4% for the prior 12 months. But with many Americans living to 25 to 30 years in retirement, it's critical to factor in inflation into your financial strategy. Let's take a look at the chart. At a 2% inflation rate across the top, if you're currently living on $50,000 a year, in 10 years, you'll need $61,000. In 20 years, you'll need $74,000. And in 35 years, you'll need $100,000. That's what inflation does. Based on longevity, if you live 25, 30, or 35 years in retirement, and we see inflation do what it's done here, will your portfolio keep up with inflation? Will your withdrawals keep up with inflation? We always like to emphasize that tax is just one consideration in an overall financial strategy. Keep in mind, this presentation is for informational purposes only, and it's not a replacement for real-life advice. So make sure you consult your tax, legal, and accounting professionals before modifying your tax strategy. For illustration purposes, we always should assume that current tax rates will not change. If they do get adjusted, we'll want to review how new tax rates may influence your financial strategy. For many people, if tax rates change, that may change their financial decisions regarding tax-deferred accounts and how to structure retirement withdrawals. In order to manage taxes, consider maximizing your contributions to tax-advantaged accounts. If you're still working and your employer offers a non-qualified deferred compensation plan, an NQDC, it's popular with a lot of executives. You may want to consider participating as a way to defer part of your compensation, as well as the taxes on it too. Capital gains are another area that investors must consider. With respect to capital gains, taxpayers in the highest tax bracket are taxed at 20%, whereas those in the lower brackets may pay either nothing or 15%. The same tax rates apply to qualified dividends. Non-qualified dividends, which are often referred to as ordinary dividends, are taxed at regular income tax rates. Just to remind you, to qualify for a special capital gains tax treatment, a security must be held for at least a year. Also, not all dividends are qualified and must meet certain IRS criteria, which we will not be able to get into today. Although you'll definitely want to speak with a financial professional and a tax professional before making any serious financial decisions, there are a couple things you may be able to do to reduce your capital gains taxes. One way to reduce investment-related taxes is to shift taxable assets to tax-deferred accounts. We're big proponents of this approach because not only does it allow investments in the account the opportunity to grow tax-deferred, but making contributions to those accounts can reduce your overall tax burden. This strategy is generally only possible for those who are still working, and annual contribution limits apply. Also, consider reinvesting your asset allocation strategy by shifting your investments to assets that generate tax-exempt income, if that's appropriate for you. Also, one of the things we like to work with our clients on is asset location. Sort of what we talked about before, where we're putting assets such as mutual funds, where appropriate, into tax-deferred accounts because they can spin off capital gains and dividends all day long or all year long. And we really don't, it doesn't matter. We want to get investments like individual securities, if appropriate, and exchange-traded funds into taxable accounts where we have a greater degree of control over the taxation on those investments. Remember, a prudent investment strategy is based upon your investment goals, your risk tolerance, and your time horizon. It is important as tax issues are, they should be only one factor that you should consider. One of the most important factors in preparing for a financially comfortable retirement is life expectancy. Got some good news for you tonight. Americans are living longer. Here's some potentially bad news. We are living longer, and that creates a challenge for any retiree's portfolio. This slide shows the probability of surviving beyond age 65 for a couple. So if you're a retired couple, both age 65, the likelihood that one of you will live to 20 years in retirement is about 84%. And there's a 63% chance that one of you could live to be 90 and spend 25 years in retirement. So if you only prepare for, say, a 10, 15, or even a 20-year retirement, there's a pretty good chance you could come up short. For this reason, it's especially important to use investment strategies that try to balance sustainable withdrawal rates with an appropriate measure of risk. Balancing these factors is critical to help you create a strategy that's designed to ensure that you do not run out of money before you run out of life. Longevity can drastically affect how you take money out of your retirement accounts. To show how important this is, if you withdraw just 1% more than your proposed withdrawal rate, you may not have enough money to continue this strategy before you die. It's a mathematical truth. This is why accuracy is so critical, because the razor-thin margin between a 1% too much and getting it just right can have a significant effect. When we sit down with people talking about their retirement, we often ask them, what withdrawal rates do you feel are sustainable? And they usually come up with a variety of answers. On average, you hear about 5, 6%, and they may be right. And only live to 95 is demonstrated above. However, even looking at a portfolio that's 50% stocks, 40% bonds, and 10% T-bills, like the one shown here, notice the impact of increasing the withdrawal rate by 1% up to 6%, and another percent up to 7%, and so on. Can you imagine what would happen if the portfolio was entirely in cash or fixed income? This shows that if somebody is too conservative, their likelihood of running out of money is significantly greater because their portfolio can't keep up with withdrawal rates. This is especially true when you add in the impact of inflation and longevity. This is one of the key things we try to help clients figure out, and that's why we recommend working with a qualified professional. I know people might not like to talk about this, but another factor that should be considered when it comes to living longer is long-term health care insurance, and that can be expensive. Although Medicare may cover many medical services, it may not cover these costs. You take a look at monthly averages. A homemaker service coming into the home is roughly $5,000 a month. A home health aide licensed is over $5,000 a month. Your assisted living facility is $4,500. Nursing home in a semi-private room is almost $8,000 a year, and a nursing home private room is over $9,000 a year. Now, keep in mind, these numbers represent national averages. The costs each of us face as we age will depend a lot upon where we live and the care we need. As well as you know, healthcare costs don't seem to be going anywhere but up. Does your financial strategy factor in the cost of extended care? So, with just these 4 factors considered, there are many more. It's easy to see the effect that effective wealth management involves a lot more than just picking stocks. Some television commercials may try to help you think that it's so easy, even a baby can do it, but there's really a lot more involved in doing it and doing it right. Let's move on to the next section of our presentation. Common investment pitfalls. One of the biggest challenges facing investors is the emotional roller coaster of investing. Letting erratic short-term market movements create anxiety can push investors into making improper decisions. You can see here that investors go through a whole cycle of emotions depending upon the market movement. So as the market's heading up, they're confident. I'm making money. This is great. Market starts to hit the peak and things start getting risky. I should quit my day job. I should do this full time. Look at the money I'm making. They're euphoric. Market starts heading down. They start getting a little bit more nervous. What's happening? What's going on? Market continues on down. They become desperate. There's no point in selling now. I've lost too much. Then they become defeated, sadly. There go my dreams of a comfortable retirement. And then all of a sudden they pick back up again and they become hopeful. Things seem to be turning around. So as you can see, there is a wide range of feelings that investors can see during the market cycles. We would like to highlight why it may be beneficial to take the emotions out of your investment strategy. This chart shows how making emotional decisions and knee-jerk reactions may hinder your performance of the portfolio. As you can see here, moving from 2012 to 2021, the S&P fared significantly better than the average investor. The S&P was up about 16%. The average investor was up about 8.7%. Why is that, you say? Well, likely because the average investor did not stay invested during the entire period. In general, people sometimes allow emotions to affect the way they invest, and instead of staying invested for the long run, they tend to buy high and sell low. There's another point we want to stress. Generally, you should not put all your eggs in one basket. The returns you see here are averaged over a long period of time. All these investments have seen ups and downs over the years, and it's very difficult to predict the future for these investments. If someone tells you they can, they're lying. For most people, a well-structured portfolio may contain a variety of these investments based on their objectives and their own personal risk tolerance. Here's some definitions of the indexes we had used in the slide before. During times of volatility, investors may seek the safety of conservative investments, or may even decide to get out of the market entirely. It's perfectly natural to want to avoid losses and protect your assets. But abandoning your long-term investing approach in the face of short-term volatility can potentially slow your progress towards pursuing your goals and make the road to recovery longer. In this chart, it illustrates how difficult it can be for a portfolio to recover after experiencing a downturn. But of course, if you're going to stick for the long-term strategy, it's vital that you incorporate some key principles. Nothing that we will discuss in this section can guarantee success or protect against times of loss, but experience shows that these key principles can have a strong influence on your investment health. Experience has taught us that there are 4 basic ways to address risk. You can ignore it, you can avoid it, you can manage it, or you can transfer it. You might illustrate it this way. If you choose to drive a car, you have 4 basic choices to make regarding managing the risk associated with that activity. You could ignore it, saying, if I crash, I'll just buy a new car. You could avoid it and say, I won't drive at all. You could manage it and say, I'll drive defensively with my hands at 10 and 2, and despite my best efforts, I'm going, if this doesn't work, I still might get T-boned. Or you could transfer that risk and buy car insurance. When it comes to investing, decisions on whether to ignore, avoid, manage, or transfer risk will vary greatly from person to person. Our job is to educate you about your options and to help you make the right decision. It's also critical for investors to consider their own personal risk tolerance. That's why whenever we build a portfolio for our clients, we always conduct an in-depth risk assessment, such as looking at the 3 basic stereotypes. We get a lot more granular than this. An investor with low tolerance would have trouble dealing with any downturn and want consistent returns, even if they're low. An investor with a medium risk tolerance, large performance swings may keep me up at night, but a moderate amount of fluctuation is okay. And then an investor with a high tolerance, even large performance swings won't derail them and their investment strategy. They are steady as a rock. Selecting a suitable combination of investments to meet your objectives is extremely important. Multiple studies have shown that asset allocation is the primary factor of influencing the volatility and return of your portfolio. Landmark studies showed that 88% of a portfolio's performance over time could be attributed to the mix of assets in the portfolio. Bottom line, it's not picking winners or jumping in and out of markets that determines long-term investment outcomes. It's picking the right mix of investments for your personal situation. Although we believe it prudent to have a passive core of investment selections for a long-term growth potential, we also know that just because something is a good investment today doesn't mean it's a good investment tomorrow. That's why we choose to engage a human element by means of finding active managers. These managers, when making decisions or team thereof, look at analytic research, forecast their own judgment and experience when making investment decisions on what securities to buy, to hold, and to sell. Although active management cannot eliminate the risk of fluctuating prices and certain returns, nor can it ensure profit or guarantee against loss, both our firm and most of the investment companies we place our clients' asset with employ some type of active management. Just to clear the air, active management is when an investment manager attempts to outperform the market by predicting market activity and can add value to portfolios by participating in market cycles and continuously changing the asset allocation over time. However, keep in mind, buying and selling securities can come at a cost of increased capital gains, exposure, and also increased transaction fees. Another area we'd like to touch on today relates to how you can leave a legacy for future generations. This area of strategy involves getting an expert legal advice in addition to working with qualified financial professional. To that end, we maintain professional relationships with local CPAs and attorneys who can assist our clients to ensure that everything works as effectively and efficiently as possible. For example, rather than just leaving each of your loved ones a lump sum of money, you can specify when they receive that money, how they access it, how they could use it, and even the tax consequences they face. Of course, to do this successfully requires putting forth the effort to prepare in advance. This is another area involved in effective wealth management. Total wealth management doesn't leave out many pieces. As we go about managing wealth for our clients, there are many strategies we employ, such as active versus passive management, diversifying both within asset classes, using alternative investments, making sure we have tax efficient investments, and diversifying across asset classes, as well as insurance thrown in there as too. Additionally, we're not advocating any of these strategies for anyone here today. The strategies we use for you personally may vary differently from the strategies from other people who are even on this call, based on a number of important factors. So please remember that we are sharing this with you strictly for informational purposes, and investing involves risk, which includes potential loss of principal. No investment strategy can guarantee profit or protect against loss in periods of declining value. Everyone's investment needs are unique, and we would need to work hard to structure a custom portfolio for each client. To illustrate how we do this, imagine a portfolio has 5 buckets. In bucket 1, it contains the money that you need to put away for the next 12 months for you and your family. In bucket 2, it contains income that you'll need in years 2 and 3. Bucket 3 contains the income needed for years 4, 5, and 6. Bucket 4 is for years 7 through 10, and bucket 5 contains the money that you'll need in year 11 and beyond. You think we should manage the money that you'll need in the next 12 months the exact same way that we manage the money you'll need for years 11 and more? Absolutely not. So, as previously stated, the first bucket contains the money we put away for the first 12 months. The second, the money for years 2 and 3, third, 4, 5, 6, and we can start becoming a little bit less conservative. How about the money that you'll need in years 7 through 10? Do you think we could start taking a little bit more risk with that? And where's the risky part of the portfolio, the aggressive part? Naturally, we'd want that to go into bucket 5, the money you don't need for 11 years or more. So basically, what we're trying to do is assess the short, the medium, and the long-term needs, as well as preparing the money into different instruments with a proper amount of risk and liquidity. In this way, we strive to ensure that you are prepared for various future phases of life. Alan Lincoln said, "Planning is bringing the future into the present so that you can do something about it now." Both the challenges and the strategies we've discussed today can be very difficult to balance properly. And as we've highlighted, just one misstep can make the difference between enjoying a prosperous retirement and winding up broke. So please, let us help you protect what you've worked so hard to earn. In summary, what are we doing to help our clients work through all the factors we've shared in this presentation? Well, we help them diversify across and within the asset classes and set realistic expectations for performance. We communicate regularly and educate them on the factors that could affect their financial future. We encourage them to think long-term, tune out the noise, and avoid knee-jerk reactions. And finally, we meet with them regularly and monitor their portfolio and make changes as needed. So, if you're a visitor here today and you do not currently have a financial representative, or if your financial representative isn't providing the services like this to you, we'd be more than happy to provide you with an obligation-free complimentary assessment of your portfolio. Even if you're content with your current holdings, it may be wise to get a second opinion, much like you would visit a doctor for a second opinion before making an important medical decision. Your financial health deserves that kind of attention as well. That concludes our presentation. I am going to hit the stop recording here so we can start taking some of the really good questions that came in. And we'll re-adjourn here in just a second. Thank you all for coming, and I'll be right back.